Welcome to this explainer. Today, we're unpacking a reality about money that honestly feels completely counterintuitive. We grow up thinking financial success is all about having a sky-high IQ, right? Like you need massive analytical brain power or some advanced math degree to get rich. We assume the smartest person in the room is just destined to have the biggest bank account. But the data actually points us in a totally different direction. Wealth, it isn't about raw intelligence. It's fundamentally a soft skill. It's driven almost entirely by your behavior. Okay, let's dive right into this with a totally jaw-dropping contrast. Picture a guy named Ronald Reed. Born in rural Vermont, hitchhiked to high school, and spent his life sweeping floors at JCPenney for 17 years and fixing cars at a gas station for 25 years. Now contrast him with Richard Fuscone. Fuscone was a Harvard-educated MBA, a wildly successful Merrill Lynch executive known for his razor-sharp business savvy, and he actually retired in his 40s to this massive Greenwich mansion. If we're placing bets on which of these two guys was the financial genius, well, it seems like a no-brainer, doesn't it? But here's where it gets wild. When Ronald Reed passed away in 2014, he left behind an $8 million fortune. Seriously, $8 million. No secret lottery win, no rich uncle, nothing like that. He just saved consistently, put whatever little he had into blue-chip stocks, and let time do its thing. Meanwhile, our genius finance executive, Fuscone, borrowed heavily to expand that 18,000-square-foot mansion. So when the 2008 financial crisis hit, his illiquid assets and crushing debt wiped him out. He went totally bankrupt. The Harvard MBA lost absolutely everything, while the rural janitor became a multi-millionaire philanthropist. This is such a brilliant illustration of a core premise from Morgan Housel's phenomenal work on the psychology of money. Finance just isn't like physics. You can't memorize a rigid formula and expect some guaranteed payout. Doing well with money actually has very little to do with how smart you are, because raw intelligence, it simply cannot override human emotion. Your analytical brain power will not protect you from panic or greed. Navigating your own psychological wiring matters infinitely more than whatever technical knowledge you have in your head. Which really brings up a fascinating question. Why do incredibly smart people go completely broke, while everyday blue-collar workers quietly build these massive fortunes? Like, why does high-level intellect fail so spectacularly in personal finance when it clearly works in fields like medicine or engineering? What exactly is the blind spot here? Well, the answer lies in behavioral economics. Heavy hitters like Nobel Prize winners Richard Thaler and Daniel Kahneman have proven this time and time again. Humans are not walking rational spreadsheets. We are deeply emotional creatures, and we are highly susceptible to cognitive biases that totally short-circuit our intellect. Take the endowment effect, for example. This is a psychological bias that prejudices us to favor keeping our own assets, even when the market tanks or the asset is just doing terribly. Simply because we own something, we inherently overvalue it. It literally blinds our logical brains and stops us from cutting our losses. And then there's the disposition effect, which is just as destructive. This is our tendency to irrationally sell off our winning investments way too early just to feel that quick rush of success and lock in a gain. But on the flip side, we will stubbornly hold on to our losing investments, watching them drain our wealth day after day just to avoid the painful regret of admitting we made a mistake. Even the smartest minds stumble here. We're essentially letting our ego drive the car instead of logic. And frankly, raw intellect is absolutely no match for the human ego. So the really crucial point here is that these abstract biases aren't just textbook theories. They manifest in very real, everyday financial behaviors that destroy wealth. Studies show that overconfident folks, especially those who actually believe they're smarter than average, engage in massive amounts of excessive trading. They treat the stock market more like a Vegas casino than a long-term wealth-building tool. We also see some really quirky consumer habits, right? Like people rushing out to blow their stock dividend checks as if it's free money, while carefully saving the capital gains from that exact same stock. It makes no mathematical sense. This perfectly transitions us to a concept called mental accounting, which was first mapped out back in 1980. Mental accounting proves that we do not treat all of our money equally, even though mathematically a dollar is just a dollar. We instinctively sort our cash into these weird psychological buckets in our brains, which leads to highly irrational spending based entirely on where the money came from or where we're currently keeping it. There's some brilliant Wharton research that illustrates this perfectly with consumer debt. If we were purely rational robots, we'd always use the mathematically optimal strategy, which is paying off our highest interest debt first. But in the real world, people ignore the math completely. Instead, they'll throw their hard-earned cash at smaller balances. totally ignoring the interest rates, just to get that immediate psychological rush of wiping the slate clean. We are literally willing to pay a mathematical penalty just to feel a fleeting moment of emotional completion. How crazy is that? But making the right choices to get wealthy is honestly just half the story. And this brings us to a mind-bending paradox. Getting wealthy and staying wealthy require two completely different behavioral toolkits. The exact same traits that help you make money, being bold, taking huge risks, swinging for the fences, are usually the very traits that will cause you to lose it all. To actually stay wealthy, you need what we can call a survival toolkit. This means adopting frugality, a healthy dose of paranoia, and a relentless focus on long-term survival over chasing massive short-term gains. Take the legendary 1920 stock trader Jesse Livermore. This guy made the inflation-adjusted equivalent of $100 million by age 30 through brilliant, aggressive trading. He was an absolute master at getting wealthy, but he totally lacked the paranoia and frugality you need to keep it. He just couldn't turn off the risk-taking. Eventually, he lost every single penny because he didn't respect the math of compounding, which absolutely demands time and surviving to work its magic. This disconnect highlights a hilarious but super profound reality about how we view money. When someone says, "I want to be a millionaire," what they almost always mean is, "I want to spend $1 million." But spending $1 million is literally the exact opposite of being a millionaire. My favorite example of this is pop star Rihanna. She actually sued her financial advisor after she nearly went bankrupt for massive overspending. Her advisor's legendary response in court was basically, "Did I really need to tell her that if you spend money on things, you will end up with the things and not the money?" It's kind of funny, sure, but it hits on a massive behavioral blind spot for all of us. True wealth is actually what you don't see. It's the unspent assets. It's the luxury cars you didn't buy, the first-class upgrades you skipped, the diamonds that are still sitting in the jewelry store. And why on earth would you want unseen wealth? Because its true value isn't about flexing on your neighbors. Its greatest value is giving you absolute autonomous control over your time. Waking up and being able to do what you want, when you want, with who you want, that is the highest dividend that exists in all of finance. All of this builds up to a highly liberating philosophy. Because we are emotional, flawed human beings, you actually shouldn't try to be coldly, mathematically rational with your money all the time. That is just a fast track to burnout and eventual panic. Instead, your goals should be so much simpler. Just try to be mostly reasonable. So, what does that look like in practice? Well, being coldly rational means constantly chasing mathematically optimal returns, which is incredibly stressful and practically impossible to stick with when the market crashes. Being mostly reasonable, on the other hand, means maximizing a totally different metric: how well you sleep at night. Let's look at Harry Markowitz. The guy literally won a Nobel Prize for creating mathematical models of risk and return. But when it came to managing his own personal portfolio, he didn't even use his own complex formulas. He invested using a mostly reasonable approach designed specifically to minimize his future regret, so he wouldn't panic during downturns and could just get a good night's sleep. Look, if a mostly reasonable approach is good enough for a Nobel laureate in economics, it is absolutely good enough for us. Ultimately, building wealth comes down to a very simple behavioral equation. Saving money is just the gap between your ego and your income. If you let your ego scale up every time you get a raise, constantly needing to prove how successful you are to everyone else, you are never going to build true time-freeing wealth. High intelligence won't save you if your ego is sitting in the driver's seat. So I want to leave you with this final thought to apply to your own life. Are you spending money to genuinely build wealth and buy back your freedom? Or are you just spending it to show people your ego?